So who trades currencies? I guess coming back to what we were talking about earlier, it's very much along the lines of markets that suit individual style of trading. Currencies has its own little idiosyncrasims in that the funny thing about the currency is if you're buying the euro, you're buying the dollar, by definition you have to be selling something else. Unlike the Wall Street where you're buying the market, the Barclays shares where you're buying Barclays shares or selling Barclays shares, selling Wall Street. In the currency market, you are buying one and selling the other, so it is a continual rating process. So if you're thinking more of it from a fundamental basis, if you come to trading from more of a fundamental basis, you are having to outweigh the performance. It may be a good call to say that I don't think the euro will perform very well next year, but it has to underperform against either the pound or the dollar or the yen or whatever currency you picked against it. That's only half the game, is getting a currency or an economy that you believe will underperform or overperform. A pip is the smallest movement the smallest unit of movement across any of the products that we offer. So in the currencies, it varies from one currency pair to another, but it comes down to the the market recognised definition. For most of the currencies, it's the fourth decimal place, but it is always worth checking the product information to check what the minimum price movement is. So the majors really are the G10 commodity currencies. They're the currencies across the euro, dollar, the euro, the dollar, the pound, the yen. The minors, by definition, are the smaller currencies, the slightly less liquid currencies. Invariably, our spreads will be slightly wider on those because there isn't the two-way flow to be able to tighten the prices up so much. Are really maybe slightly misnamed, but ultimately they're the markets that are not generally quoted across the bank. So just need they're things like the Polish zloty or the Mexican peso and stuff. They're markets that aren't as liquid as others. That's really the only difference. So you have to have a genuine belief. I think to trade those, you need a directional view, as opposed to some of the majors whereby you can trade in short-term time frames, whereas I think if you trade on some of the exotics, as much because of the width of the spread, you need to have more of a longer-term view on them. Also, buying the euro-dollar, you're always buying the first currency that you said. So by going long the euro-dollar, you bought the euro, you have by definition sold the dollar. Similarly, if you buy the pound versus the dollar, you're buying the pound, selling the dollar. It's always the first currency quoted. And interestingly, some currencies were quoted euro-dollar, some currencies are quoted dollar-yen. They do flip around which currency it is. It's always stated on the product which it is. You're always buying the first currency. So it's as simple as the other way around. If you don't buy the euro-dollar or buy the dollar-euro. You buy the euro-dollar or you sell the euro-dollar if you want to sell the euro and buy the dollar. Again, the euro-dollar, very popular market. It's quoted worldwide, seen worldwide, very liquid, 24 hours a day, and always an ability to get in and get out of a trade easily because of the liquidity in the underlying. Well, underlying Forex trading, you are actually by trading the first currency, you are receiving your revenue in the second currency. So if you trade at euro-dollar, you are generating dollars on your trade. Whether you bought it, sold it, whether you made or lost money, you've made or lost dollars. On the spread bet world, we trade in pounds per point. So in other words, even though you're trading a euro-dollar currency, which doesn't mention sterling at all, the fact that your account is in sterling and you bet £1 for every pip that euro-dollar moves, you make pounds on the up, lose pounds on the down, rather than the second currency. So for the foreign exchange market, you would generate dollars if you're trading euro-dollar, you would generate yen if you're trading euro-yen. Whereas on spread betting, it's always pounds per point on that final pip movement. We receive our euro-dollar quotes in from 16 liquidity providers. So we have 16 of the top banks across London and Europe who provide us prices, two-way price across all these markets. There is no centrally traded exchange, so there is no official high, low, mid price at any time. We use, ideally, our first point of call is always we go back to Bloomberg. Bloomberg being a agency that just acts as a purely price provider. So we use them as a point of reference to show that the prices are in the right area. The Bloomberg price and our price will always be in line because, as I said, we have 16 banks who are also contributing into those price providers such as Bloomberg and Reuters. Our first point of call is always Bloomberg on any dispute over price. But we take ours from, we don't have, there is no centrally cleared currency market, as you say, so there's always a certain discrepancy around those. But that's what we use as our point of reference, our point of fairness. We quote fixed spreads 24 hours a day. So the advantage being that whether that's at 2 in the morning, whether that's at 8 in the morning, whether that's over a data release, you know the spread that you're going to be trading when you get in or get out of the trade. We have a limited maximum size that we'll take on any one trade. It doesn't mean the maximum size of a position that you can build up, but to do any one trade, we'll have a maximum size which varies across all the currency pairs, across all the products, is available on the market information side. And that's really just to give us a chance, as I was explaining earlier, to hedge those positions in the market. So whilst we don't mind if you want to buy £1,000 a point of euro dollar, we ask you to do it in clips of 200, purely to give us a chance to go and hedge that position out in the market. I think the major influence the financial crisis had across all the markets was adding volatility to the markets. And I think that's perhaps possibly one of the skills, certainly as any trader, let alone a beginner trader, is to learn when to increase your size, when to decrease your size. And extra volatility across all markets does mean greater market movements. So certainly in the currency markets, it caused massively increased ranges on the day, movement on the day, and possibly the sensible money manager out there is going to reduce the size of a market that is trading in 3 times the ranges that it was trading the 2 weeks prior. Yes, I think generally we see, certainly there are major currency moves. So if the dollar is weak, all of the currencies linked to the dollar will move, correlated between those. By definition, they're all correlated because they are all just a matrix of, if you pick 3 currency, euro dollar, euro dollar, sterling, and euro sterling, by definition all 3 are linked. They all move in some form of tandem or opposite. A lot of the moves we see will be dollar based. So as a general rule of thumb, if euro dollar is moving up, the sterling against the dollar is also moving up. Yeah, so again, coming back to a one-tick movement is stated on the market information, which is always, we use the market uniform standard terms on all of them, but it's always worth checking on the market information to check what those are. So I think this is probably true of all of it. We find most of our trading volumes occur during European hours, so between 8 and 5 UK time. We find the least amount of trading probably in the overnight shift between sort of 10 p.m. and through till 6 in the morning. But I don't think that's true of just ourselves. I think that's probably the markets generally trade in the European and US hours. You tend to get less market movement overnight. It doesn't mean you get no market movement, but you certainly get less, and I think we certainly see a lot of our volume, as I said, between those hours.